Hey, good morning, my friends. Today is Thursday, June 27th, 2024. I, of course, I'm Hammer with Originator Success here, the daily mortgage rate update, the only place on the web where you guys get to join me live each and every day, 9:30 a.m. Eastern Time on Facebook or on YouTube to see what's going on with mortgage rates and pricing, what's going on with markets, and just enjoy each other's company and chat to start the day. If you're here this morning, say good morning. If you're watching on the replay, don't forget to give me a hashtag replay in the comments. Let me know that you were here. Always appreciate that, whether you're here live or on the replay. Don't forget to smash that like button on Facebook, tag an LO friend. That's right. Share this thing and maybe post it in another group. Put it in one of those groups. You've got the MLO network, you've got Brokers Are Better, you've got the Mortgage Pub. Share this in a group. It's always appreciated when you guys help us grow. If you are on YouTube, don't forget to subscribe and click the thumbs up button, all that good stuff. Remember, if you'd like to sign up for our written email lock advice, I send out an email each and every weekday morning, www.ratelockadvice.com. You're welcome to grab any excerpts from it. You're welcome to share it with real estate agents. You're welcome to grab some of that content, share it with them as your own. I don't care. If it helps your business, you've got my blessing. You don't have to give me any credit whatsoever. If you'd like to sign up for our text alerts, they're $7 a month. You can sign up for those at www.retextalerts.com and go ahead and be alerted with what's going on. If you'd like a reminder that I'm going live each morning, we send that out right before I go live. You can opt out anytime, of course, but check that out at hmmr.io/reminder. And if you would like to learn about how we can help you to get more loans from Google and social media, that's what Originator Success does, and we do it damn well. Check us out at originatorssuccess.com. Find out how we can help you to get loans and get some more business. So, now that I've gotten all that out of the way, let's go ahead and say hi to our live folks. Who do we got here this morning? Say good morning if you're here. Let me know that you are on. First one to say hello this morning was Mr. Ron Siegel, and he said today is National Ice Cream Cake Day. Today is National Ice Cream Cake Day. However, today's question of the day, I was going to keep a little bit simpler, and we're going to throw that on the bottom. So as I'm saying hello to all of you, question of the day is at the bottom of the screen. What time period would you travel to if you were given a time machine? Would you go to the 50s? Would you go to the 2000s? Would you go to the 20s? Would you go to the 1800s? Would you go to the BC? Where would you go if you could go? I'm reminded of a bunch of movies. Remember Time Bandits? It was a movie from the 80s. It's actually, I think it's on Hulu right now or Max. It's on one of the streamings. It's a bad movie, but it was a fun movie. I was reminded from that. So what time period would you travel to if you were given a time machine? I'd like to see the Middle Ages. I would definitely like to see the Middle Ages. I'd like to see Rome in its prime. That'd be pretty cool. So if I could travel in a time machine and, of course, a place, I'd like to go see Rome. So where would you like to go? Anyway, as we're sitting here chatting, good morning, Megan Lindberg, Harry Dennis. Great to see you, Yasmin Martin. Who else do we have? Michael Love, Tim Klyla, Bill Stevens. Great to have you here, y'all. James Mahan. Good morning, sir. Thank you for joining. And that looks like we've gotten everybody that's on this morning. So let's go ahead and get to the good stuff here. Rate sheets today are going to be similar to yesterday, maybe even a smidge better. We did actually pick up some gains this morning. Let me pop this up on the screen so you guys could see it. And let me just move this around a little bit so you can kind of see what I want to show you here. All right. So it always locks up. I don't know why. Let me refresh it so that it does its thing. And actually, while I'm doing that, let's just go put it here. And I will come stand next to it. And here we go. All right, so I'm waiting for this to pop up. But anyway, rate sheets this morning should be similar or a smidge better than yesterday, which is actually nice because yesterday bonds lost ground through the day, but then we saw a strong, I'm going to refresh this one more time. We saw a strong reaction, positive reaction this morning to the 8:30 a.m. data, which is basically, it's the final numbers for the GDP for the first quarter, which, that's way in the rearview mirror. Nothing really to get excited about there. The jobs data came in a little bit weaker because there were more jobless claims, more continuing claims. That's part of it, but really, just kind of that reaction. Well, this is not working for shit this morning. So let's go ahead and take a look here. Yesterday, we had seen mortgage rates creep a little bit higher. We'd been, 7.02, 7.01. and then they crept up yesterday to 7.06. So we should see that actually improve a little bit today. Now that this is live again, let's go ahead and show you where we're at here and what I've got going on my mind. So if we take a look here, you can see this is the 48 hours, basically the last few days. Here's today. Everything to the right of this dotted line is today. Everything between these two dotted lines in this column is yesterday. And you saw that we had lost ground after really holding steady right around this level here. This was right around, what is that, 100.70-ish. We kind of lost ground, and it started on today is Tuesday afternoon. Wednesday, we just continued to lose ground through the day. There was really no reason for it. It was just kind of bond drift, as I call it. And the reality is it wasn't really that much movement. It just looked like movement because rates have been so consistent for 4 or 5 days in a row. So we lost some ground yesterday. You can see we were starting the day a little bit weak here this morning, and then that 8:30 data gave us a bit of a lift, and bonds trading well off of that. So the reprice risk on the day is low. It's very unlikely that we have to worry about losing ground on this at this point. It should be a fairly quiet day. As far as the outlook goes, rate sheets should improve a bit more tomorrow. We're looking for a positive reaction to the data. Let me get my head out of the way. I want to show you guys. I'm actually going to get rid of this as well. I want to make this full screen, and I'm going to make this a little smaller. I want to show you guys. Okay, so take a look here. You could see, I'm going to take a screenshot of this so that we can kind of really get this. But our peak is 100.78. 100.78. That is the magic number that we have seen going all the way back till March. We haven't seen mortgage bonds break that number. Let me grab a screenshot here and we'll draw some arrows and stuff like that. So okay, so now that we got this up, and here, let's put it on a clean background so we can see there's no distraction. All right, so taking a look here, let's go ahead and draw this as a straight line. We're going to put this at that 100.78 level right here. Okay, so you could see a couple of times where we have been hitting this level over here, hitting the level here. We kind of pushed through and tested it here. We broke through it and then fell back below it. Here we tested it again. Here we started the day higher and lost ground. Here we started the day higher and lost ground. You can see that this 100.78 has been a very, very strong technical level dating all the way back. This over here is all back in March. Okay, so I'll go ahead and let's draw a call out, and we'll call this March. Okay, so this was March when we were last above this 100.78 level with any consistency here. And actually, it actually starts right here. So that's where you could see all of this. When we were spending time above that level, it was all here in March. And since then, we have dropped below it and then tested, below, tested, dropped, tested, come down. Now, right here, remember this big down red candlestick. This was, and I'm going to put this on the outlook here. Actually, I'm going to get that out of the way. All right. So looking at this red candlestick, this was the jobs data last month. And we saw a recovery. Now, I bring that up because next week we're going to get the jobs data again, the BLS jobs data. But tomorrow we're going to get the PCE inflation data. And I think what's going to happen is I think we're going to see that improve about 20 basis points. And I think we'll test this level again if we can get near it. We may only pick up 10, 15 basis points, maybe even less than that. So let's talk a little bit more about the inflation. So the personal consumption expenditures, let me make this all side screen here. We're going to do that. Do this. All right. Make sure you answered the question of the day. If you haven't answered, by the way, hello, Monica, Deb Dixon, Kim Mason. Great to see you guys as well. What period would you travel? No one likes this question. No one's answered. What period would you travel to if given a time machine? I'm going to ancient Rome. I'd like to see the ancient stuff. I'd like to see when they built the pyramids. That would be cool. Like going back to the 50s wouldn't do anything for me. You going back even into the 1800s. Not really all that different. I'd like to go way, way, way back, way back. I want to see the old, old, old days. Let me know what you guys think of in there. Good morning, Nathan Einkorn. Great to see you, sir. So, taking a look here, let's talk about what we should see in the PCE data tomorrow while we're floating into it. And again, I'm going to go ahead and throw that on there. Let's get that on there now. So, today, floating is good. Tomorrow's inflation data. Come on, show that. And we'll pop this up here like this. Okay, so floating into tomorrow's inflation data can really only help us. So this is the release from the April PCE inflation data. Now remember something. Why do we have faith in what the PCE data is going to be? Because we've already gotten the CPI data. So it's kind of the cat's out of the bag. It really shouldn't be all that different than what we saw with the CPI data, which came in a little bit better than expected and helped us out this month. So looking here, when we look at the chart for where things are at, we're looking at these core numbers. Now, let me throw this up here, and that way you guys can see it. So the outlook is that tomorrow rate sheet should improve a little bit. Unlike tomorrow's inflation data, it's unlikely tomorrow's inflation data could hurt us. Don't expect any big improvements either, though. We're not looking for rate sheets to dramatically improve, but it should at least bring us back to where we were at the beginning of the week. Not as good as we were hoping this week. We were hoping to actually improve a little further. Probably not going to do that because yesterday we lost some ground, but it could at least bring us back. Now, the core PCE. Now, what do we talk about the core? The core excludes food and energy, which are considered to be more volatile. And that's why the markets look at the core number, the Fed looks at the core number, not your headline number. So the headline number is here, the core number is here. But that could be affected by the price of oil, what's going on overseas, different things like that. So when we look at the core number, the core PCE is expected to come in at 0.1 for the month, which we have not seen, by the way, even going back to December, right? So December, we were back at 0.2, then we jumped. And this is why we have not seen rates drop at the beginning of this year. January was 0.5. February 0.3, March 0.3, April we saw go down to 0.2. It's expected to see it drop to 0.1. If that happens, we're going to get a positive reaction from markets. If it comes in at 0.2, I don't think we would see that much of a negative situation, right? And when we come to the year over year, this is over the previous month. And then when we go to year over year, we're looking at 2.9. Then 2.8. Now, when the talk of the Fed, this is the Fed's favored gauge of inflation. When everyone says about the Fed trying to reach 2%, this is the number that they're working on. They're not talking about the CPI, which is higher. And Ron Siegel just pointed that out. Very good point, Ron, and we'll definitely point that out for everyone as well. Let's see. Here you go. PC should be better than CPI since nearly all our inflation comes from shelter and motor vehicle, and PC has a lighter weighting on shelter. So that's a good point as well. And it's something that is being factored into the expectations. What Ron is saying here is when they look at the different categories and they come up with this percentage, right? Then they look at shelter costs, and shelter is weighed. It gets a more of a rating. It gets more weight in the rating in the number that's used for the CPI than for the PCE. So good point. But let's take a look here. Remember, the Fed's trying to get to 2%. Well, we were 2.9. Now we're at 2.8. So the expectations right now is that this month they're expecting to see 2.6. Now, if we don't see 2.6, is it going to be a huge problem if it comes in at 2.7? Probably not going to see a strong reaction. We shouldn't see a huge negative reaction, but we're not going to see a positive reaction, right? And that's kind of the problem. But if it does come in at 2.6, then expect to see bonds improve on the day. We're probably going to go back and test this 100.78 level. Right now, mortgage bonds currently, they are at 100.54. So if we test 100.78, that would be about 25 basis points higher than where we're at right now. And that's what we're hoping to see tomorrow. If we do see that, you're going to see rate sheets improve to the best levels that we've seen in the last couple of weeks, which if we use Mortgage News Daily as the reference point, it's 7.017%, right? So we are just a little bit off of that. I mean, it's really minor. It's not a lot. So that's kind of where things are at right now. That's why the advice is, like I've said, cautiously float anything closing near term. Let's see where that data comes in tomorrow. It's unlikely that it could hurt us. It would have to come in much higher than what it's expected to really hurt us. You could see it drift a little bit, but remember, and tomorrow we're going to talk about the PCE data, but we're also going to talk about what goes on next week with the jobs data and all the labor data, JOLTS. We've got the 4th of July holiday. We've got the BLS report coming in right at the end of the week on Friday, the 5th, which traders are going to be out of they're going to be looking for a 4-day weekend. So we're going to see some volatility next week. And that's but we don't have to worry about that Monday or Tuesday. We don't have to lock on Friday yet. So definitely not locking today is the point. We want to see what that jobs data comes in tomorrow. See if it can give us a bit of a boost, help to at least, today we should recover some of this. Yesterday was say 7.06, today would be like 7.04, 7.03. So if we do, if we get the numbers coming in at expectations tomorrow, we could, get a little bit better. We'd be back into like this. But again, we're so majoring in the minors right now because it's just such a small amount of movement. We're not seeing rates move a lot. So let's see. Ron said, I'd go back to the 80s. College days were a lot of fun. Yasmin, I'll step on it. Oh, I'd go to the Garden of Eden and slap the apple out of Eve's hand. And yeah, you guys are funny. So, all right. Well, there you go. Thank you for answering the question of the day. I think we hit everything. Let me know if you guys have any other questions. I'll answer them. Otherwise, like I said, I think that kind of sums it all up. And that's it, my friends. So I think I hit on all my little things going. Oh, I wanted to kind of share with you one thing real quick too. Take a look. Michelle Bowman. It's funny. She gets so much screen time. They love to, they focus on all the different members, but whenever she is like so hawkish, this is gonna be like borderline hurt feelings. But if you had like upper middle class suburban mom vibes from anybody, it's Michelle Bowman. And I could just imagine her walking around with her red Stanley Cup, talking about how we need to raise interest rate. I just don't think she gets it. I really don't. She is extremely hawkish and talks that, we may need a rate hike. Not even close. Not even close. Like, look at the data. I know my man Ron Siegel could point out that there is so much discrepancy in the jobs data, in the BLS data, the Bureau of Labor Statistics and the BLS data. We get jobs numbers and then they're revised twice after we get those numbers. So if they say, hey, there's 100,000, and then next month they zoom in better and they revise it, and the following month they revise it again. And if you look, the revisions have been bringing the number of jobs created, so much lower than what has been released and announced. And that's what's been hurting us. And when you look at, say, we look specifically, actually, I'll go back here to this chart. Let me move this so you guys can see what I want to show you here. Hold on a minute. We're going to put it right here. This was the labor data. Here, let me see. Let's check the date on it here. So that's the May 28th. Here, yeah, it is Friday, June 7th. Wow, I can't believe it. Just doesn't seem like there's anything happening after that. But this was Friday, June 7th here. And you could see that when we got that headline. Oh, you guys can't see it because I don't have it in the screen. Let me move it over a little bit more. Sorry. There you go. So when you see this huge red candlestick, we saw, look at the buildup up to that. Look at where we came from. This, as mortgage bonds go lower, rate sheets got worse. And we saw so much buildup over the week before, 2 weeks before the jobs data really, and again, testing that 100.78 level here, falling just below it. And then Friday, that jobs data, boom, it sunk us. We saw a strong recovery. Look at the size of the tail on this candlestick. But the next couple of days, by the end of the week, we were right back where we were. And we tested going above it, but yet couldn't kind of break. So I'm not worried about the jobs data that we get next week. We'll talk more about this tomorrow, but this was because the number of jobs created came in much higher than what was forecast. And we know that that's actually junk and it's garbage. So what Ron said, the funny part is they revised them twice. They're still wrong compared to the real numbers. Yeah. Let's not even get into that. You're absolutely correct. So anyway, my friends, that's what we got. I just wanted to show you that stuff. So I will see you tomorrow. We'll talk about what happened with the PCE data, what rate sheets are going to look like. We'll talk more about what we can expect heading into next week. And that's it. So Ron said the true numbers rarely hit the headlines, so they don't move the market. Exactly. Yeah, that's and it is. It's always buy the rumor, and what do they say? Something like that, right? So definitely, I agree. So, all right, my friends, I'm gonna wrap it up. I'll see you guys tomorrow, and we'll talk then.